March Consumer Price Index showing inflation cooling. It actually fell 0.1% month over month. Economists were expecting a 0.1% rise, and it rose 2.4% on a yearly basis, with the U.S. now placing a 10% baseline tariff rate on most trade partners and a 125% rate on China. Could this be the last time that we see inflation easing this year? And if so, what does this mean for the Fed? Joining us now, we've got Claudia Sahm, New Century Advisors chief economist and former Federal Reserve Board economist. Let's just start with that question. Is it the last time that we see a print like this and some easing?
This could easily be the last really good CPI day for a while. But it's going to take time. The tariffs that have gone into effect, it's going to take time for it to show up in the data. And it really is an empirical question. How are businesses going to deal with these higher costs? Are they going to pass it on to consumers? To what extent? And there's a real wild card how we deal with what are punitive levels of tariffs on China, which is an important consumer good importer that we use. So I think there's just a lot of questions, and it's going to take time to see it play out in the data. And it's probably what we see happen in the pricing data is probably going to be as messy as what we have seen in the policy setting. I mean, this has just been really disruptive. So it's going to take a while to work through this.
And Claudia, obviously investors were euphoric about the 90-day pause yesterday, but when economists like you crunch the numbers, it does look like consumer goods are actually hit harder after that announcement yesterday because of the degree of goods that we are getting in from China. You can see on your screen right here a rundown of the average tariff rate on consumer goods. You can see at the bottom the increase after that 125% reciprocal tariff on China was enacted yesterday. Claudia, talk to me about the read-through of that. What is the impact of that?
Right. So that is going to be a big question how we deal with that, because some will say, oh, we're not going to end up collecting those tariffs. That's just ridiculous. No one's going to pay that for Chinese imported goods. It's like, well, that is a distinct possibility. But that means if in the short run we have a big pullback in the supply of goods, well, it could show up in higher consumer prices. T-shirts could be the new eggs here shortly. If we're not, if we're missing that supply, we have learned painfully the lesson of if you have disruptions in supply, in the end, it shows up on the consumers with the prices. So we could end up with higher prices, but not that much higher tariff revenues from China if that's how businesses react to it. So again, that's just because these are uncharted territories for us in recent times, and to see how that shows up in inflation is just that's quite uncertain how that happens.
Okay, and so we've heard this word uncharted, we've heard the word uncertainty come up from some of the economists and CEOs kicking off this new earnings season as well with relation to their conversations around tariffs. With that in mind, is there any analog that we can look to in the past to really get a sense of how long it takes for tariffs to show up in inflationary prints?
So this is what's really tricky, right? The level of tariffs that we're at now. I mean, the United States has not seen that level of tariffs in we're basically like 100-year level of tariffs, and so it's important to go through our models, look at kind of the estimates. But any kind of modeling that we would have as economists is based on a historical record that really doesn't have tariffs going from 2 to 20% in a short period of time. So that, and I think that is why we keep hearing the word uncertainty, because any decision maker knows that I can bring you an estimate. I can give you odds of say a recession happening or not happening, but we all know that there are huge bands around it, because what do we have to base on this? Mm-hmm. Right? And the tariffs here too, they are very broad based. We're hitting a lot of goods. They're happening very fast. And so we can say, I think with a lot of confidence, the direction this is headed, prices will be going higher. There will be a hit to growth, but it is really not, I mean, we really can't say with any degree of confidence what those numbers will be. And so that means you gotta wait. It's an empirical question. We have to see the data, how the behavior changes. And unfortunately, waiting, whether you're the Fed or you're a business maker or a consumer, sometimes waiting comes at a cost.
Mm-hmm. Yeah, Claudia, to that end, can you put the toothpaste back in the tube on tariffs, especially in the context of the labor market, which so many of our sources have been telling us, people like you, telling us that is the key question moving forward for the Fed, is that labor market crack?
Right, and we should remember, yesterday told us we're very focused on tariffs, and there's a high degree of uncertainty about it. But I also take a lesson from this just about the policymaking process in general coming out of the White House. There are several policies the administration has chosen to focus on out of the gate that are negative growth policies, whether it's restricting immigration, whether it's downsizing the federal government, cutting contracts, and then tariffs on top of it. And frankly, in all cases, the policy process has been really disjointed and confusing. Mm-hmm. So I think there's kind of a bigger meta picture of like what are the risks coming at the economy right now, and it's pretty unsettling. And I fully understand why in that setting, say you have the Federal Reserve being very, very patient. We want to see the data. We want confirmation that this isn't going to be a persistent boost to inflation. But that should tell us all that they're not stepping in anytime soon.
Claudia, when I was speaking with the Delta CEO, Ed Bastian, he was acknowledging some of the efforts that they're taking right now as they enter into what they're calling defensive mode because of the uncertainty around tariffs. And he didn't go as far as to say that they need to cut back on their headcount or their workforce, but they are taking other measures within their operations of the business. However, there are some businesses that are going to have to consider whether or not they need to descale or downsize their businesses as a result of that uncertainty. To what extent would you be looking for tariffs to also have a headwind on the employment situation?
Right. No, tariffs are absolutely a headwind on the employment situation. It may end up being first and foremost cutting back of hours, not giving the raises. There are ways to save that don't involve layoffs. And we haven't seen corporations doing layoffs, up to this point. So, but that is a margin for them to adjust. It could be, the company doesn't pass it on to consumers in terms of prices. Well, but then they have to work on their margins, and then they have to do cost savings. So someone is going to pay for this much higher level of tariff within the business community, with the workers, the consumers. It's not clear who's paying. But and it may be that if all margins adjust, that's what gets us to the least disruptive path. That we just slow down, and then the price levels adjust, and we get past this, and we don't have a severe contraction. But it's going to be a whole multitude of decisions being made here.
Joe, let's start with you. What are your initial takeaways here?
It was a very good print. Energy dragged it down. We saw the very much long-awaited improvement in shelter. I think that the unfortunate thing is that because the tariffs are on the way, this is the last clean print we're going to see before we get those tariff-induced inflation increases that are going to impact the aggregates over the next 60 to 90 days.
Tom, if this trend continues of cool inflation, do we see the Fed getting an excuse to cut?
Well, if the trend of cool inflation continued, but I think as Joe rightly pointed out, I don't know if that's what we should expect. In fact, to be more clear, I think we should expect the exact opposite. There's now a lot of inflation in tow, and it's what happened yesterday. I think this is an important idea. What happened yesterday with this seemingly the pause, which hopefully goes beyond a pause, is that we've removed the deep left tail scenario. But even with the pause, you still have 10% baseline tariffs. You still have tariffs on Canada and Mexico. You still have auto tariffs. These tariffs are going to wind up showing up still through the inflation channel, which will ultimately wind up hitting growth over the balance of the year. So I think it's still right to expect the Fed to cut over the balance of this year. We're still looking for 2 cuts. But I think, again, Joe's right. I think that this number is probably going to be a one-off and what will likely be firmer inflation prints over the coming year.
Tom, with that in mind, and it's a solid reminder, because yesterday everything changed, or at least seemingly so, because there are still going to be, to your point, those 10% tariffs. So it's just not as high unless it's some of what's already been kind of targeted towards China here, and that got ratcheted up even higher here. So when you consider how much is also tied to China with the broader inflationary picture because of the import and export mix that we do have, how does this continue to show up, and where would consumers see the first impacts there as the Fed would be looking through some of the indexes within prints like this?
Yeah, so I think what we have to keep in mind is when we look at what the impact is likely going to be from the tariffs that are already in place, right, and the tariffs that seemingly may not go away, right? I stress the may not go away. We'll see. Clearly, there's a lot of negotiating going on down in D.C. But from what we see today, you're looking at a removal of anywhere between a half and 1 full percentage point from growth over the balance of the year. So if your baseline expectation for growth was 1.5%, if these tariffs that are still in place actually come to fruition, your 1.5% could easily become zero. And in an environment like that, that means that you're going to wind up seeing some margin compression, which means that the real risk is that you see companies go after labor. And then in which case, I think that really puts the Fed very much in play.
And Joe, I want you to chime in here. Given the growth constraints that Tom just laid out, how concerned are you about a crack in the labor market and off of that, any potential recession?
Well, Tom nailed it, right? And by the way, kudos, Tom, on restraining yourself there on the intraday tariff rate, because it's getting a little bit much. Look, you see that 2.4% top line and that 2.8% core. Enjoy that, because by midsummer, it's going to be 4 and 4.5%. When you put tariffs like we are on American companies, marginal cost curves increase. That means revenues are going to slow, profit margins are going to be compressed, and we're going to see the unemployment rate begin to rise. Fed's going to be in the most difficult spot because you're going to have unemployment rising simultaneously as inflation is increased. The playbook says that when you're in that situation, you lean towards the part of your mandate that's further from its target. That's going to be inflation. Therefore, if you're out there expecting a rate cut in May, or a rate cut in June, or a rate cut in July, I suggest strongly you revisit that thought, because I just don't see any rate cuts until September at the earliest. Like Tom, I've got 2 rate cuts on the books, but we'll have to see how all this evolves. Lastly, we have a call now where we think we're going to have a mild recession this year. It's going to look more like a garden variety inventory correction lasting 6 to 9 months. Our probability of a recession is now at 55% over the next 12 months. We're going to have to see how these tariffs and all of the other things that are going to come on the backside of this impact overall growth, but things are going to slow to a crawl here pretty quickly.
So if we do see that recession coming in the second half of this year, Joe, Tom, how does a crisis of confidence impact what we're seeing in the bond market? Are we going to continue to see higher yields moving forward? And just your take on all of the volatility that we've seen in the bond market overall as an indicator of any potential recession?
Yeah, for sure. So I think this is a good tag team between Joe and I. I think he really laid it out very, very nicely. I think what's going to wind up happening is you're going to really start to see this more stagflationary kind of backdrop evolve in the immediate term, where you're going to see the inflation lift, and then you're going to start to see some more stagnant kind of growth. And I think what that will do is it'll slow what is an already slow reaction function from the Fed. So I think initially, I can easily see yields sort of hanging in this level now. On 10-year yields, we're at 4.30. I can easily see us hanging in around there. But I think for the next handful of months, and then only when the backdrop finally really starts to sort of break down a bit more, the Fed really starts to relent on this idea of, hey, we really need to be more focused on inflation. That's when I think you get the release. Because I think the market is going to be acutely aware that the Fed is going to be slow to respond.
Mm-hmm. Joe, just lastly, if you're a consumer reading through this print, what's the number one takeaway?
Food prices went up, and that's going to be a bug under the saddle of everybody here going forward for the remainder of the year. And I want to congratulate all those volatility traders on what's going to happen for the remainder of the year, because you're going to do quite well.
Tom, Joe, thanks so much for taking the time here with us today. Really appreciate it.
Thank you.